Hi, it's Carl Allen. Welcome back to module number 5. This is lesson number 3. So in this lesson, I'm going to walk you through the valuation and deal structuring models that we use inside of the Dealmaker Empire Builder program. And you'll remember from the last lesson, we used two different valuation methods. One is the simple model, also called the enterprise value or EV model. That essentially takes the business's adjusted EBITDA, its profit, with all the add backs that we went through in the last lesson, and then applies a multiple, and then looks for the potential debt financing that we identified. And we can see how we can structure the deal. And now the second model I'll share with you is called the balance sheet method. And remember, most businesses that we look at are going to be valued on a multiple of the profit. But some businesses can have very, very strong balance sheets, but fairly low profitability. And in those cases, the balance sheet method is going to give us a completely different and likely fairer answer. So let's see how these valuation methods stack up vis-a-vis this US-based engineering deal that I've been looking at. And you'll notice in the EV model that we've populated the numbers from the financials that we looked at last time in lesson 2 of this module. So Y0, which is in column C, that represents the current year's numbers. And in this case, this deal was evaluated in 2019. If you have a forecast for the future year, or you're halfway through the current year and you have a pretty good feel on what the numbers are going to be, that might be your Y0 number. But for this example, I'm just going to use the 2019 numbers. Then Y-1 is the previous year, in this case 2018, and Y-2 is 2 years prior, so that's 2017. Now, there are 3 different types of cells in this model. So anything in gray needs an input. So you type the numbers into that cell. Anything in white is self-calculating. So do not touch any of those cells. Otherwise, you're going to screw up the math in the model. Then the gold cells, those are the output cells that are also self-calculating. And that's the data that we're going to take into module 6 to prepare our offers to buy the businesses that are in your funnel. So just to remember, gray is an input cell, white is a self-calculating cell, and gold is the output self-calculated through the model. These are the numbers that we're going to look for. So let's go through it. All I've done is populated the revenues and the adjusted EBITDA, including the add backs that we reviewed in lesson number 2. So Y0 was just to have a $2.9 million in revenues. Y-1, 2.3 million, and Y-2, 2.1 million. Now we add the adjusted EBITDA numbers based on the negotiated add backs. If you remember, we agreed to some, but not all of them. So the profit numbers for Y0 are 698,000, Y-1, 301,500, and Y-2, 363,000. So then the model calculates the average. You don't have to do anything here. Even though the profit dips slightly in the middle of the year, the average profit over the last 3 years was $454,000 and change. Now, if the numbers were trending down, so if Y-2 was high, Y-1 in the middle, and Y0 was low, the model's programmed to take the current year number because we don't want an average when profits are falling. Plus, if the profits are falling during one of your meetings with the seller, you should find out if those downward financial trends are going to be fixed. So just remember, when profits are going up through the forecast period, it's taking an average. When profits are going down, it's just taking the Y0 or current year number. And in this case, Y0 shows a spike in performance. So the average revenue will ensure that we're buying the business at a sensible level. Now we want to look at the multiple. So we've talked a lot about multiples, and I showed you the kind of graph last time for the ways that multiples change. Now, obviously, the size of the profit makes the multiple go up, as do proprietary business, loads of intellectual property or IP, high barriers to entry, and other sophisticated stuff. But remember, the average multiple for a small business is generally between 2x and 2.5x. Sometimes it can go as high as 3x for the right business. And as you know from the analysis we did last time, this is an excellent business. So I'm prepared to pay a 3x multiple, but the structure of the deal is actually more important than the multiple. So let's go through the numbers. So here, the enterprise value of the business is 3 times the average profit of $454,310, which is a little more than 1.36 million. Next, we want to calculate 100% ownership or equity, which is in row 14 of the model. So in this case, we make adjustments by first adding the $450,000 worth of property value. Then we deduct the $141,899 of primary debt, so the overdraft, the HP financing, all those different things. And we break out the $250,000 property debt under long-term financing. That's the commercial mortgage that the owner has on that building. And the debt goes into this model as a negative number. So the model adds the positive and the negative numbers together to get the total cash adjustment. So the next line is for cash adjustments. You'll remember from lesson 2, there's about $254,000 of surplus cash in this business, meaning there's more cash in this business than the business needs to trade. Now, at this early stage, we want the surplus cash to cover at least 1 month's sales revenues. So we look at the current annual revenue, $2.9 million, and we just divide it by 12, giving us around $245,000 in monthly revenue. So with $254,000 in surplus cash, we're good. So we add that as a positive cash adjustment in the model because it's the seller's cash. It's more cash than the business needs to trade. Now, later on, if we pursue this deal further, we'll do a full 12-month cash flow forecast. And there's a tool for it, by the way, so we'll know exactly what the required working capital levels are month to month. But at this stage, we're just trying to get a sense of what we think this business is worth and how we're going to structure the deal. So although we add the surplus cash to the valuation, the good news is we can also use it as part of the funding mix when we go to buy the business. It's money that's available to us. So we're going to be buying this business using this method, 100% equity for $1,675,000. And what you then do in row 16 is specify how much of the business you actually want to buy. So in this case, we're buying 100% of the company. However, you might only want to buy 80% or 70%. The seller might want to keep a small bit of the ownership and stay. So you can actually change the numbers. So you can say, okay, I want to buy 80% and the whole model changes. I might want to buy 50%. Again, the whole model changes. You've got that flexibility. Next, you want to add in some costs for fees. Remember, you're not going to be paying the fees. The CPA due diligence and the legal costs to actually close the deal and paper the transaction. Those are contingent fees that come out of the business once the deal closes. So you want to make sure that you've got enough financing in the deal to pay those costs if and when you assume ownership. Now, as you know from the analysis last time, this business has more than $1 million of working capital inside of it. So we don't need any more working capital after we've bought the business. But let's just say I want to take $25,000 off the table. You know, think of it as a deal fee for yourself. So I'm going to add that in to the financing as well. And if you don't need some cash out of the deal, you can put that as a 0. So what we now need is $1.75 million and change to buy this business. So now it's time to figure out where we're going to get the money from. So we go to the right-hand side of the model under the heading Funded By. Now we know from the indicative financing work that we did last time in lesson number 2 that we've got almost $550,000 of receivables. But rarely will a banker finance all of that. So we're going to apply 80% funding. Again, the grey cells, you type them in. Inventory is just under $300,000. So we're going to apply a 30% funding. A financier will typically only finance inventory that's physically held in a business's location, as opposed to, say, a fulfillment center or a dropship facility. And the reason being is if you default on the financing payments, the banker has the legal right to come in and take the inventory right off your premises as payment. In this case, I actually think we can get more inventory funding because it's an engineering business with some long-term defense contracts and a really high value set of components. So I think we might get 50% on the inventory as a loan to value, but for now, let's just use 30% to be conservative. And there's also some fixed assets in here. You'll see in the upcoming module number 7, financing, there are a lot of different ways to borrow against fixed assets. You can do sale and leasebacks, or you can just finance them with the bank. That's what I'm going to do here. So I'm applying a 50% loan to value. Now, just a little word of caution on this. Some of the funding in the business may be secured against those fixed assets already. So we might need to tweak these numbers a little bit later. But for now, I'm going to assume I can borrow the full 50% on the $233,000. Next is property. Now, I know as well that there's a mortgage on the building, and that's what the property's worth, $450,000, with a $250,000 loan already secured against it. So I'm only going to allow $200,000 as the equity in the property. And as you can see, this is calculated automatically because we've input both the property value and the debt numbers in column C on the left-hand side of the model. So I'm going to take 70% on the property, which will get me $140,000. And then I've got that good old surplus cash, which though I'm paying for it in the valuation, I'm also using it to co-fund the deal. So I'm going to be able to raise just over $1 million of financing from this business to buy it. And even if I say, look, I'm not comfortable, I'm not going to get anything on fixed assets, I'm going to put that to zero. The model works all that out differently. So worst case scenario, let's say there's no funding on fixed assets and I'm only able to raise about $920,000 from financiers to do this deal. That means if I'm going to pay $1.75 million for the business at a 3x multiple, and I can finance $920,000 from the business itself, I have a deferred amount of $830,000 left to finance. So the model automatically calculates what those deferred payments are going to be. And that's the seller financing, which again, you'll learn a lot more about in module number 7. This is the business paying for itself by paying the seller over a negotiated time frame using some of the future profitability of the business. So if we raise $920,000 in financing, we've got some fees, we've got some cash that we're going to take out. I need to pay $830,000 and change in seller financing payments. So I'm going to try and do that over 3 years, which means that the business's profit has to kick back about $276,000 and change to the seller for each of those 3 years. And I'm left with just over $1 million of total debt to still repay in this business. So I've got the new debt that I've raised. That's going into the business, which is going to be nearly $920,000. But I'm already assuming some debt in the business that I've adjusted for in the valuation. The $141,899 in primary debt, the $250,000 property debt that's secured against the building, and I've still got to pay that money back over time as I'll be the new owner of the business. And I'm assuming it as part of the deal, and I've knocked it off the price of the business that I'm going to pay. So I know that I've got to pay $1,057,000 and change back, and I'm going to assume I'm going to pay most of that debt back over 8 years, except for the property, which I will do in 15. So whilst I've got $276,774 to pay back each year for seller financing, I've got about another $110,000 a year of cash also to pay out for the financing, the external financing to buy the business. So that means that I need to cover $386,000 and change per year for the next few years in order to buy this business. So still with me? Great. So now let's see what the outputs are. So I know from the $920,000 in funding raise that I've got fees and cash that I want to take out. I'm going to be able to pay $844,800 to the seller as a closing payment, with the remaining $830,000 to be paid out equally distributed seller financing payments over the next 3 years. That equals the total funds required. But since I'm inheriting just under $400,000 in debt as well, the total consideration or the total value of the deal is actually just over $2 million. So hopefully that makes sense. Okay, now here's the key: payment cover. This is the key magic number, the green box at the bottom of the model. This also calculates automatically for you, and you want that number to be greater than 1.5. You see, the payment cover shows that the business is expected to have enough profit, enough adjusted EBITDA to cover the annual deal financing payments by a 1.5 cover, if not more. You want enough of a cushion in case something happens in the business so you don't run into any issues repaying that debt. So in this case, row 23 on the left-hand side shows the current adjusted EBITDA of $698,000, and row 22 on the right-hand side shows the maximum per year payment of $361,000. So divide 698,000 by 361,000 and you get a 1.9 payment cover, which is great. But let's say, just for example, we were paying a 5 times multiple for this business. We're still going to pay the deferred payments over 3 years. But look, it's going to be a lot more money because we're paying a lot more for the business. So the payment cover is now way below 1.5. So it wouldn't be safe to do that deal. I know at a 3x multiple with the financing I've got available, I'm going to be able to comfortably do this deal. So that's the simple model method for enterprise value. Next, I'm going to go and look at the balance sheet model and see what the differences in numbers are. So here's the balance sheet method. So what we're going to do is we're going to just copy over the current EBITDA profitability. Again, that includes all the negotiated add backs. So that's $698,117. And we're only using the current year. And then we're going to just restate the 1.675 million enterprise value to buy 100% of the business from the EV model. So yes, if you're going to use the balance sheet method, you still need to do the left-hand side of the EV model. Next, we look for the net asset value or the book value of the business, which is on the balance sheet. Another way to say it is, what's the shareholders or owners' equity in this business? And as you'll see, 2 years ago, it was almost 1.1 million. Last year, 1.35 million. This year, 1.53 million. So again, we're going to take the 3-year average, which is about 1.33 million, and then calculate what is the adjusted retained profit. So the current year's retained profit is $420,620. Last year, $189,681. You know, last year wasn't a great year. And then 2 years ago, it was just over $237,000. Now we layer those add backs in again. So I'm breaking it out between the non-recurring costs and the owner's salary that we talked about in lesson number 2. And the model is going to give us the adjusted retained profit totals. And if we take the 3-year average of those, it gives us an average adjusted retained profit of just over $384,000. Then I apply a multiple to that. That's half of what I use for the enterprise value. So since we used 3 times in the EV model earlier, here I'm going to use a multiple of 1.5. So I take the adjusted retained profit average and I multiply it by 1.5. That's going to calculate my goodwill, the extra amount I'll pay above the average book or net asset value. Because when you're doing the balance sheet method, you're buying the balance sheet as it stands. In other words, technically what you would get if you liquidated all the assets dollar for dollar and then paid off all the liabilities, you would have no business, but you would have $1.33 million as an average number. So we're taking the 1.33 million average, that's the net asset value, and adding that goodwill value to get the total deal value. So that's giving us a valuation of $1.9 million. And using this method, we're valuing the company at 1.9 million versus the 1.675 million in the EV model. That swing, it's giving us a different data point to consider in module number 6 when we start constructing our offer sequence. And what it tells you, and I deliberately picked this Real Deal because it gives us similar answers, it tells you you've got a very, very strong, healthy balance sheet. Whilst it's a profitable company, it's kind of been up and down over the past few years. But because we've taken the average adjusted retained profits, it means that the balance sheet method has given us a slightly higher valuation than the enterprise value. And here again, we're buying 100% of this business. We've got $50,000 in fees. We've got the $25,000 cash for ourselves. So we need some extra funding, almost $2 million of funds. We're inheriting about $392,000 of debt because, again, we're buying the balance sheet, so it's already baked into the valuation. And again, the financing's exactly the same. Nothing's changed there. Just because we're changing the valuation method, it doesn't impact whatever the financing is that we've got inside of this deal. We're plugging the surplus cash number in here. Though it calculates it in the last model, just copy the $254,000 across. Then what we do in this is we put in a trial closing payment. So what I normally try and do, especially my first offer, is I'm looking to split the valuation 50-50. So I'll pay half of it down and I've got a ton of funding available, which I have in this example, and then I'll pay the rest over time through seller financing. So in this example, we're going to be paying $950,000 down and $950,000 more as deferred financing payments. Now, to get my payment cover above that 1.5, I've got to do this over 4 years now instead of 3. So if this was over 3 years, we'd be bang on that 1.5 number, which is kind of right on the limit there. And because I'm paying more for this business in this example, I'd like to be a lot more comfortable to do it over 4 years. So it doesn't affect really the cash flow. It just means you're paying for the business for an extra year. So $952,000 and change is the deferred amount to be paid over 4 years at $238,000 per year. And then obviously we've got all of the debt that we're repaying, the new funding that we're introducing to buy the business, plus the current debt that we're inheriting as well. So let's assume we're going to pay all that on average over 8 years, probably more like 10 because we've got property financing in there as well, so the real estate. So nice and comfortable, $355,437 is the maximum payment going out per year. That means our payment cover is now 1.96. So I feel a lot more comfortable at that level, almost at 2 versus the minimum 1.5. So those are the two methods that you can use to value a business. You can take your deals and plug your numbers in exactly as I've shown you. You just have to play around with some of the variables, especially the multiples, but do not go higher than 3. You can look at the number of deferred years as well. And obviously, you can change some of these funding values, but I wouldn't recommend it. Those are the standard numbers from my experience. And when you get into the financing piece, we'll see how those skew. But for now, for these initial offers, these variables are going to be spot on for you. So I hope you found that useful. I will see you in the next lesson where we'll go into the merger model. Now, the merger model will show you how much money you're going to personally make from building your empire and merging your target business with the one that you've already got. So I will see you on the next lesson. Until then, bye for now.